Let's break down this chaotic week in the crypto sphere with our next guest, Howard Marks. He is the co-founder and CEO of StartEngine, and we'll be talking about another very important topic, which is venture capital, which many investors think is an indicator of the health of the broader economy. Howard, welcome back to the show.
Thank you. Happy to be here.
I want to talk about your venture, your latest acquisition, the state of venture capital, and of course, the state of cryptocurrencies, and one of my personal favorite subjects, GameFi and the gaming community and where e-gaming is headed next. But first, let's break down some of the most important headlines of the week. FTX and Binance, so Binance backing out of the deal that they initially probably agreed on. Now, the FTX token was down about 90% after Binance dumped it. Let's break down what happened afterward. A lot of investors can't withdraw their cryptocurrencies and holdings from the platform. Sam Bankman-Fried personally published a series of apologies today on Twitter. What is your take on how this is impacting the broader crypto sphere?
Well, I think this is a classic run on the bank story. It's very simple. It's not complicated. There was some bad news that was tweeted about the company, and people panicked and wanted to withdraw all their money. But the problem was, unbeknown to these investors, is the company was lending the money to one of its affiliates. And so when they want to take all their money out, it isn't there. So if you think about a run on the bank, that's happened a long time ago in the Great Depression. And the Federal Reserve and all the regulators have put some very special circuit breakers on banks so that run on the bank does not hurt consumers and investors. Well, in this case, FTX is not regulated, so there were no circuit breakers and there were no warnings prior to this run on the bank. And so at the end of the day, they couldn't pay all of the investors. And here you are in a situation where the company is going to stop the withdrawals, and who knows what happens next.
Another issue is that Alameda Research, which is the firm tied to FTX, which is another firm that Sam Bankman-Fried, founder of FTX, founded, had a significant holding of FTX token. So here you have a company that's an affiliate of FTX that basically has a lot of holdings, and basically your company that you founded, the valuation of that company is significantly based on the valuation of a token of that particular that is an offshoot of that particular company. That in itself wouldn't really be a problem typically, right? Except in this case.
Yeah, that's not an issue at all. The token does not represent the equity of the company. The token is just a token. The issue we're talking about here is the money that the investors put in the accounts, and they need to take them out. That's the issue we're talking about. So they would stake their tokens, whatever it is, Ethereum and Bitcoin and any kind of token, and expect that they can withdraw them at any time. But that's not the case. And that is why there was a panic. People did not know what to expect. So when you are in an uncertain time and you're reading Twitter, which it seems where all the news is happening, then you're going to make a move, which is simple. I want my money back. And so Alameda Research was loaned money from those investors and put into their company, unbeknown to them. And then they did some kind of alchemy, and who knows what happened. Maybe they've made some bad bets, who knows? But that money did not return.
Okay. Isn't that sort of the model that traditional CeFi banks operate on? You have deposits that you give to your bank, and the bank lends them out to other either depositors or creditors or other firms. I mean, this is not a new model, correct?
That is correct. But here's the one main difference between the two models that you are mentioning. One, the model of a bank has regulators who are reviewing on a monthly basis the financials of the company. They have circuit breakers. So if they do not meet the net capital rules, there are methods for stopping the losses. And there is FDIC insurance, which is an insurance program where each account holder is insured up to a certain amount of money, which is about $300,000. Now, so you could argue, yes, it's similar, but in the case of FTX, there is no insurance, number one. Number two, there's no visibility on their balance sheet. A bank, you can look at their balance sheet at any time. Anyone can look at a bank's balance sheet. But here, there's no visibility. No one can see what's going on. So I would argue that should FTX been regulated, this would not happen. They would have not allowed these intercompany transactions, which are between two parties who are in control, which is FTX and Alameda Research are controlled by the same shareholder.
Okay, so let's come back to that. Now, what do you think is going to change in the realm of regulations around cryptocurrencies following this case?
Well, I think it's a clear classic big explosion that will have everybody feeling that regulation is necessary at this point. Most of the crypto world does not want regulation. That has been very clear. SEC is trying to convince Congress to give them more resources so they can build a certain amount of regulation for the crypto. There is regulation right now for securities and for banks. That is very clear. There is no dispute. But the question, how does it apply to crypto? And that is going to be what the regulator is going to work on. And I think this is really the defining moment as to when regulators are going to be given the power, political power, and investor protection power to come in and start demanding that these companies do regulate themselves.
So I've read that Binance, after reviewing the books on FTX, pulled out of the deal. Do you buy that story? Why do you think they really pulled out?
I think they really pulled out because the mess was too big. It puts them at risk. So they decided if they could clean it up for very little money, they would have done it. But I think that, what I've read is they were talking about a $6 or $8 billion hole. That is big money for anyone. And I think they were probably afraid to be dragged along into the mess. And so they just pulled out. It seems logical. Okay. A lot of people are accusing them of manipulating the market. But who knows if that is true or not? Because ultimately, at the end of the day, if the company was properly regulated, even if Binance came in with saying that there are problems, you turn to the regulators for answers. But here there were no one to arbitrate. Nothing. No one.
FTX had holdings of $32 billion roughly, and should they collapse, they're filing for bankruptcy as we speak. What's going to happen to not only the holders of cryptocurrencies on the exchanges, but also the creditors, lenders? This is going to have a wide reaching impact on the entire financial community, is it not?
Yes. So here's how the bankruptcy works. It's not very complicated. The secured debt comes out first, right? Those are the banks, the lenders, anyone who has loans with the company, they come in. And then the big mystery is, how do you treat the account holders? That is a mystery. Why? Because these are not accounts. Now, in a bank, a real bank, those accounts are a liability to the company. So they have to be repaid first before you pay the shareholders and some of the debt holders. But in this case, it's not clear. It's not written anywhere that says what happens to these accounts should the company liquidate. And that is a big mystery. And some people are talking that these accounts are going to be considered common shares. Who knows? It's very hard to tell.
Are you concerned about the spillover effect onto other cryptocurrencies that may be linked to FTX and Sam Bankman-Fried? Solana, for example, was a longtime favorite token of SBF, and that's down significantly this week as well. Is that a particular case that you're worried about? Is this the beginning of a larger contagion effect onto other cryptocurrencies?
I think it will have a major effect for a period of time. We're not sure how long. The thesis of the cryptocurrency world makes a lot of sense. There's a lot of technology here, a lot of innovation that needs to be preserved. However, it always comes down to the same issue. It needs regulation, because what happened today is a classic run on the bank. It needs regulation so that investors are protected. But it doesn't mean stifling innovation. It doesn't mean saying that crypto is bad or tokens are bad. No, it means, how do we create a situation where we can get the confidence back from investors that this is a great opportunity financially for them? But until these questions are answered, you're going to have more of these, I would say, big events that can scare people away. And the supply demand model, if people are starting to sell, then the price goes down.
Generally, what should be the business model of an exchange or a lender or an asset management firm? This is not the first time people can't withdraw their holdings on a crypto exchange. We saw what happened to Celsius earlier this year, for example. CZ from Binance tweeted this a few days ago. He said, 2 big lessons. Number 1, never use a token you created as collateral. I think he's indirectly referencing the FTX token. Number 2, don't borrow if you run a crypto business. Don't use capital efficiently. Have a large reserve. He says, Binance has never used BNB for collateral and we have never taken on debt. Okay, so Binance aside, do you agree with the philosophy here that he's espousing in regards to running a crypto business?
Well, what he's talking about is something very simple. What business are you in? Are you in the business of collecting fees for trading? Are you in the business of lending money? Now, if you look at Wall Street, the collapse of Lehman, it's very clear. They were in both businesses. They were in businesses of collecting fees for trading, and they were also in the business of making investments and taking positions in things, assets, mortgages, for example. Now, what he's talking about is a very simple principle that he is abiding by. He says, we don't have proof, that you should be in the business of collecting fees. Why do you need to be lending money? You don't need to be efficient. Efficiency means every single asset on your book is being efficiently used to have a return on capital. And that's what he's talking about. And he's right. FTX should be in the business of collecting fees, period. End of story.
What about the business of yield farming? You need to lend. You need to lend in order to attract a higher yield for your customers, right?
Well, that's different. On behalf of the customers, if you're helping the customers make investments or take loans from someone else and you collect fees for that, there's no risk because you're not taking a position. But if you're the one who's paying the yield, let's say you're paying 14% to a customer and then you're going and taking that money and receiving 18%, you're taking a position because you're in the middle.
Yeah.
What CZ is saying is don't be in the middle. Just stick to your business, which is transactional. So if you were just transactional, there cannot be a run on the bank because you have no positions. You have the money that the investors put in the accounts, and that stays where it is.
All right. So looking forward then, how do you think these cases that we've seen in 2022 will affect the outlook for cryptocurrencies in terms of price, in terms of sentiment and adoption?
I think there's going to be a continuation of the crypto winter for a while. And then when it all merges out, there will be regulation and things are going to go great.
The cryptocurrency space at its peak was around $3 trillion of market cap in total for, if you count all the cryptocurrencies, I believe. It's significantly down from that, of course. Now, looking forward, do you think this crypto winter is going to have any effect on the rest of the capital markets, in particular venture capital? Venture capital, which is a subject we're going to talk about right now. Do you think those two areas are interlinked? Of course, there's venture capital within the crypto space, but I'm talking about, liquidity drying up all over the place. What are the causes? What are the impacts?
I don't think they're that related, frankly.
Okay.
I think you could say $3 trillion is a real big number. That is true. But a lot of those coins, some of them are no longer accessible by people. So they are still counted as part of the amount. And then frankly, I don't think these numbers are exactly correct. I mean, I think there's no true accounting, where you have audit was a separate entity. I think the press tends to put everything together and say it's $3 trillion. But anyway, whether it's 3 trillion or 2 trillion or 1 trillion, it doesn't really matter. I think venture capital invests in all sorts of things. One of them is cryptocurrency companies who are using crypto as a means for creating new financial products. But then they also invest in biotech and green tech and all sorts of great stuff. I don't think it really has a big impact.
Okay. Venture capital this year saw a downturn, like other market participants. Y Combinator actually earlier this year sent a note to its project saying that they advise projects to cut back on spending. Now is probably a time to stock up on capital, preserve your runway. Not a very happy note. That was just one example. Before we talk about the future, let's talk about what happened this year. Obviously, economic downturn, but what are some of the other causes of a decrease in funding activity in the VC space?
I think you see the same phenomena here. One, when the markets are very volatile, they go up, they go down constantly, and there's a sentiment that we're going into a recession, the inflation is high, that creates a lot of, I would say, concern for the future. It's short-term concern or long-term, it's not clear, but it creates concern. And what happens with the venture capitalists, they get pressure from their limited partners, who are usually pension funds and university endowments, and they are asking for caution. Well, guess what? Those VCs, they make money on the money they're being invested in their funds, so they're going to be cautioned. And what that means is they're going to invest less. They're going to look at their portfolio and they're going to say who lives, who dies on their portfolio. The ones who live, they're going to actually start mandating cuts, and they will put in some more money to keep them alive. The ones that they believe are going to die, they're going to stop funding them altogether, and then they're up on their own. And as you know, it's very hard to raise money if your existing VC is not participating in the next round. So this is creating a lot of pressure on companies. Y Combinator made their note, which is a classic note. You see this every time there's a downturn: conserve cash. What they're really saying is this: you're not going to get any more money. And if you're not going to get any more money, and if this is the last money you're going to have, you better live, and you're going to have to cut costs significantly and improve your models.
How do you think this downturn is going to prompt businesses, startups, to restructure the way they do business? How are they going to increase their runway after this year? How are they going to think of new business models to, like you said, operate and survive on their own without additional funding?
Well, I run an equity crowdfunding company called StartEngine, and we're seeing a lot of companies coming our way who are venture capital funded, who come in and say, look, we need to raise capital. Now, some of them will have success in equity crowdfunding, some will not. Obviously, that it's not an absolute, but we see equity crowdfunding as a great way to gain capital from the consumers who may care most about the mission of the company.
Okay, can you break that down for us? Just on your platform, for example, where is there still interest? The crowdfunding capital, which sector, what types of businesses are people still investing in?
That is a great question, because we are seeing some excitement in the green tech world. Electric mobility, vertical takeoff aircrafts, solar energy, alternative energy sources. It's extremely popular. And the reason is because investors believe it's the future, and they don't have that many opportunities to invest early on, as you know. Most of the times when a company goes public, it has already reached a lot of its value. And if you see the trends on public offerings, the IPOs, typically they go down after they go on the market. So the investors, when they invest early in the company at its infancy, they have a lot of room to grow with it. Now, the risk clearly is higher. We understand the risk is higher, but it's still an opportunity, and they love being part of the journey. So we're seeing beverages, alcohol beverages, distilleries, breweries are doing great. Consumers are very excited by those brands. Those are new brands. And then, of course, technology, artificial intelligence, even cryptocurrency businesses that are early stage are getting a lot of capital. We see also tiny homes, construction because of the housing crisis. A lot of people want to invest in new models, new ways of building lower cost housing. So all of this put together has created a very healthy market for equity crowdfunding during this crisis, where money from venture capital is being scarce. Money from Wall Street is almost non-existent right now.
It's non-existent. Okay. What would prompt a return of capital? Is it the end of a recession? Is it perhaps the end of the crypto winter? Well, you said they're not exactly related, but I think sentiment overall in all sectors is just very weak. What's going to prompt a return in sentiment?
It's hard to predict the return, but it always happens. It's one of those certainties you can say. it will happen. Yes, it will return and people will sober up. But you could argue, are lessons being learned here? No, they're not learned. There's no lesson to learn. Why? Because it's greed, opportunity. When the markets come back, and they come back slowly, efficiently, there will be a new renewed sentiment. You just need one or two examples of companies going on an IPO explosive, and then everything is back. Everybody's back. Everybody's excited. There's a new generation of entrepreneurs who just experienced this crisis, who feel very strongly that things are going to be amazing for the next 10 years. It's very possible that cycles are now longer than they used to be. Who knows?
I've been hearing, just based on personal anecdote, I've been hearing that a lot of investors have a lot of dry powder right now, and they're just waiting for valuations to come down a little bit more before they deploy. Is that something that you can back up, or is that not true?
I don't think that is the case.
Okay.
I think they're worried about failure. If you invest money, and FTX is a good example, they've raised billions of dollars, and that is a zero right now. Zero. I think it's failure they're concerned. They don't mind if the valuations go down and they can invest into it. But why would you invest on a down valuation if the company's prospects are very uncertain? You're probably better off holding your capital at this point until there's more certainty. And then that certainty, when it happens, maybe the valuations go up a little bit, but it doesn't matter. That's not the thesis of a venture capital, because they take a preferred position. And again, all sorts of strings attached to their investment that they can control. But failure, they can't control that, because the only way they can avoid failure is putting more money. And a lot of them call it good money after bad money. So it's really that their concern.
The risk of failure, correct me if I'm wrong, Howard, but the risk of failure is not market specific, right? Even in bull markets, when everyone is rushing to invest, you still have projects that fail. You still have bad management teams and bad ideas that just flop.
Yes, but you can fire the CEO and you can restructure the company and you can get it back on track. You can do that if you're a venture capitalist, because you have control, right? We're not talking about a regular shareholder. We're talking about the venture capital. They can artificially create success. Of course they can, and they've done it before. But in this moment, in this time when they have limited capital and a lot of pressure from their limited partners saying, hey, don't do the wrong thing for us. We don't want to lose our money. They're going to think differently. And a lot of their theses are going to go out the door, and they're going to have to rethink their portfolio entirely. And so when someone comes into their door saying, hey, invest in my company, they're not that excited right now. Now, I'm not saying all of them. I'm just talking about in general of the market. Of course, there's still some winners, and some of the greatest winners are going to happen now. But in general, this is what's going to happen. They are going to be very reluctant to invest their money.
Why? Okay, but we were talking offline about the difference between VC and seed capital, and we're seeing that in the stats, actually. I was reading an article, and I'll show the article on the screen. But this year, apparently the first half of 2022 saw a record amount of deals in the U.S. of seed capital being deployed, 2,900 cases of deals closed. Why the discrepancy here?
I think the discrepancy is very clear. You have a lot of VCs who want to put small money to play as an option so they can see what's going on. They have visibility into that sector, to that company. But that doesn't mean that they put enough sufficient capital to have control of the business. So they're willing to option. And it's cheap, very inexpensive for them because they have huge funds. So if they make an investment of 100,000 or 300,000, it means nothing. It really means nothing on their balance sheet, but it gives them the option to see what's going on, because if they see something really great, they're going to want to move in.
Tell me about your deal with your latest acquisition, actually, Seed Invest. I'm just going to read the first paragraph of the press wire that came in not too long ago, a couple of weeks ago. A consolidation is underway in the equity crowdfunding industry. StartEngine has agreed to acquire fellow equity crowdfunding platform Seed Invest from Pluto Holdings, an affiliate of Circle Internet Financial. Tell us about the genesis of this deal and what you hope to accomplish.
So here we are. Equity crowdfunding is doing really well in this marketplace right now. We decided it is time, when the markets are down and capital is harder to raise for companies, to buy one of our competitors, which is Seed Invest. They're owned by Circle. Circle has a lot of success in the crypto world. And we figured, okay, look, maybe they are willing to consolidate the market with us and become one of our investors. And that deal was made. And we acquired Seed Invest, which is one of the largest participants in the market. And between us and them, together, we're going to continue to grow equity crowdfunding.
Okay, perfect. And again, not meaning to beat a dead horse here, but we're seeing firms, investment firms, Sequoia Capital, for example, just issued a tweet saying that they're not heavily exposed to FTX, but they are a little bit. They're assuaging or sort of assuring investors that things are going to be okay. Perhaps the crypto space overall, crypto winter is going to really put a lot of pressure on venture capital, perhaps even equity crowdfunding platforms like yourself to scale back. Is that going to be the case, you think?
Well, look, I'm talking to you on behalf of equity crowdfunding. I don't think that is the case. In fact, VCs don't have that much investment in our world. They typically invest in private companies and they don't invest on our platform. Okay. They like having control. They want that board seat badly, especially now. So they want to know that should the CEO go in a direction that is too risky, they want to stop it. I think what's going to happen is this: the VCs are going to continue to invest, but much more carefully, which means there will be less deals available for entrepreneurs. They will come to our platform. They will come to StartEngine and others. Why? Because capital is available. They're going to have to do a lot of work to raise the capital, which is something I think they're pretty used to doing. It's a different kind of work than going to the VCs and meeting and doing flying out and having those meetings. It is different. It is about marketing yourself to the public.
We're going to wrap up soon. I want to talk about the metaverse finally, but before I go into that category, suppose I'm a startup guy and I come to you, Howard, for advice. Like you said, VCs, seed investors, angel investors, everyone, crowdfunding platforms, everyone's just going to be a little more careful with how they deploy capital. Careful is not necessarily a bad thing from the investor's standpoint. They're probably more stringent with their criteria when selecting a partner to work with. If I'm a startup person, what do I need to be aware now in order to restructure myself or position myself to be an outperforming company? In other words, what do I need to do now to attract capital, given that everyone's tightening up, everyone's becoming more careful, like you said?
Well, I would say this. In my world, what they need to do is, one, build a community of fans, customers, and end users who care about their mission. Build that community and then talk to that community about investing into their company directly. I think this is a great model. It works. Now, what they do with the money, how to deploy it inside of the company, it's the same as any other startup. You have to be prudent, especially in these times, because you don't know if you're going to be able to raise more money. Now, what we do know is in equity crowdfunding, the market is different. It's different because consumers are very interested in being part directly into the company early stage. And that is a new phenomenon. You did not see that before. Now, VCs still play a very important role, as you know, but we play a new role. And I think in this crisis, it will emerge and people will look back and say, this was a silver lining of this new economy, that equity crowdfunding is here to stay and it's very viable.
Moving on to the last category, my personal favorite category is gaming. I've been a longtime fan of gaming, been a longtime fan of your work because you are the co-founder of Activision, which later acquired Blizzard, which has produced a studio that's produced some of my favorite games, Diablo, World of Warcraft, StarCraft. Big community, like you said. It's a business model that has worked. Let's talk about the future of gaming now. Let's talk about where I can experience World of Warcraft in 20, 15 years from now. Is it still on my desktop?
Well, it's probably going to be different, the experience. I think what people are looking for are more immersive experiences, and that's why people are talking about virtual reality, which, by the way, exists since the 1980s. It's not a new idea. It just became more accessible, cheaper, faster, better. So I think augmented reality, virtual reality is one of them. Another big one is gambling. The idea that you can actually gamble inside of games is going to be huge. People are going to want to do that. Not different than how you do it in sports. the fact that games can become a sport is an extraordinary achievement for the game industry. And then I would say also having crypto involved in games makes a lot of sense because the items you buy inside of a game could be permanent, meaning they're not part of the game, owned by the game. They are actually owned by the player itself. But right now, if you play World of Warcraft, which you did for a long time, your character and your items are owned by the company, not you.
Yes.
Even though you may say, no, that this is my character, this is my account. No, 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 no. If you read the terms of service, you don't own anything. You're just a database entry. But if you use cryptocurrencies to own items, now those items are actually physically owned by the player. And that's, I think, a major difference that you will see coming up in the next few years.
One thing I don't understand is the difference between major game studios and emerging studios in the way they approach GameFi. So GameFi, simply put, is a model in which players can earn money through playing games, either through cryptocurrencies or in-game tokens or whatever the case may be for various games. You're seeing a lot of startup game companies do this. Even established game companies, Splinterlands is one of them, very popular game. But I'm not seeing the biggest studio, correct me if I'm wrong, but I'm not seeing Activision Blizzard deploy the same model on their World of Warcraft platform, for example, or Diablo, or any other games. Call of Duty, Modern Warfare just came out. I mean, I'm not able to earn cryptocurrencies playing Call of Duty, right? But you would think that would be a huge business opportunity. Why are they doing this?
Well, it's very simple to explain. I mean, if you look at most of those models, those are house of cards. The idea is it's a classic house of card model where the people who are early in are making money and the people who are coming in are hoping to make money. But the problem is that they will realize that there's not enough for everybody to share. So the top of the market make a ton of money, talks about it, attracts the people on the bottom of the pyramid. And then eventually the pyramid collapses because once the bottom realizes there's not enough for them to earn, pay their rent, have value for their time playing the game, which is not that important, frankly, it's just the earnings that matter, it just collapses. And you'll see that with, games like Axis Infinity and all these things, they're just going to collapse. If the game is great and people are having fun and building communities around them, what will have value will be the items. That is true. Items is different because items is not earnings. It's just collecting. And collecting has value.
But I don't have IP ownership on my World of Warcraft sword, right? So how do I own these items in game?
Well, you don't own them, but if you play games like CS:GO, for example, you'll have a gun and you can trade the gun. Most of the time, these markets are being manipulated by the top players. But the reality is this: once it becomes a blockchain event, then you can look at everything with full transparency and trust, and so you'll know what your item is worth and how you can sell it or not sell it. And that, I think, is different than earning. I look at collecting as a hobby. Earning is your ability to pay your rent and feed your kids, for example. And I think those games that are play to earn, or whatever they do, those terms are just going to collapse.
Okay, they're going to collapse. So you're not a big fan of the play to earn model. What about gaming? And final question I'll end here. What about gaming in general? The video game space has been for a while now larger than both movies and music combined in terms of their overall revenues globally. Number one, will that continue to be the case in the foreseeable future? And number two, how can investors benefit from the new emerging trends that you've just described now?
Well, I think, look, there's no question in my mind that gaming is going to continue to grow. Why? Because these are interactive experiences. They provide a different experience than a movie, for example. You immerse yourself into worlds. It's so much more addicting and fun and engrossing. In fact, there's some even papers out there that show that it helps you even with real life, where you're a better decision maker. You have a better hand-eye coordination. There are a lot of benefits in gaming that is going to be discovered over the years from a cognitive point of view. Now, how do you take advantage of the new gaming trends? It's very simple. You need to invest in the new gaming studios, the new ideas. The big companies, Activision, Electronic Arts, all these companies are mature. You can invest in them, but there's no ability to really have a big return. On the other hand, if you invest in companies like on our platform at StartEngine that are in the gaming space, you now can access this opportunity. And I think this is a great, it's really game changing, if you'd like me to use that word.
Okay, perfect. Howard, I hope that our interview is game changing for a lot of the viewers that have watched this. So fantastic having you on the show, and thank you for your thoughts. I look forward to speaking with you again next time.
Thank you. Really appreciate it.
And thank you for watching Kitco News. I'm David Lin. Stay tuned for more. And don't forget to subscribe to our YouTube channel.